You can follow all the right money rules, save your paycheck, work hard, invest early, and still realize the scoreboard isn't moving. The standard financial playbook is designed to keep you functioning inside a machine, trading your finite time for a linear wage. When you rely on a salary, your income is entirely tethered to the hours you work. This earned income is taxed at the highest possible rates, leaving you with enough to maintain your current lifestyle, but almost nothing to scale. The people generating massive wealth aren't necessarily working harder than you. They simply understand that money doesn't follow the rules taught in school. It obeys a rigid set of mechanical laws based on momentum, structure, and asymmetry. This data visualization illustrates the difference. The flat line represents cash flow, which pays the rent and buys the groceries, but the accelerating curve represents equity. Equity is ownership in a system that compounds in value completely independent of your daily labor. Every hour you spend maximizing cash flow for an employer is an hour spent building the equity of someone else's empire. To break out of this cycle, you have to transition from the person providing the labor to the person controlling the outcomes. Most of us are conditioned to accept linear risk. We are taught that to get a greater reward, we have to put an equal amount of capital or effort on the line. You bet $100, you hope to make $100. This bar chart demonstrates the elite alternative, asymmetric returns. Investors look for scenarios with a small, strictly capped downside, paired with an upside where a single success multiplies their initial investment by a factor of 100 or more. The true skill isn't in finding a bigger payout. It's in keeping the exact same potential return while systematically engineering the risk closer and closer to zero. This is why risking 15 years of life savings on a single business venture or stock tip is a critical error. It violates the core rule of bet sizing. Risking the entire empire on one hand means a single bad break wipes out your ability to keep playing. The ultra-wealthy don't aim for one lucky strike. They structure their investments so that even if 5 deals fail completely, the 6th deal easily covers the losses and generates surplus. Their objective is to ensure they can never be knocked out of the game. Once downside protection is established, the next mechanical law of capital is leverage. Leverage multiplies your equity without requiring you to use your own money or time. When individuals like Elon Musk need capital, they don't sell their shares and trigger massive tax bills. They use their existing equity as collateral to borrow billions from banks. Because debt isn't classified as income, it isn't taxed, allowing them to fund massive acquisitions while keeping their original wealth intact. Wall Street sells the public a very different strategy: extreme diversification. You are advised to spread your money out across hundreds of different stocks and mutual funds, just to stay safe. But investors like Warren Buffett build generational dynasties by doing the exact opposite. They find a few highly specific assets, study them until they understand every variable, and then concentrate their capital heavily into those positions for decades. Spreading your bets across 100 companies isn't a strategy for maximum growth. Diversification is simply a hedge against your own ignorance. When you deeply understand the risks and have direct control over the outcome, concentration is what drives wealth. You might assume that because you can't borrow billions of dollars, these laws don't apply to you. But the creator economy has introduced a highly accessible class of capital: digital leverage. There is a clear hierarchy here. At the bottom is affiliate marketing. You recommend products for a commission. It costs nothing to start, but because anyone can do it, the competition is fierce and the margins are incredibly thin. One step up are brand deals, where companies pay you a fixed rate to promote their product. It pays better, but you are still just trading your linear time and audience access for a flat, unscalable fee. The third tier is paid communities. You charge a monthly subscription for access to a private group or specialized knowledge. The recurring cash flow is strong, but maintaining that community requires relentless energy that often leads to extreme creator burnout. Above that sits the service and coaching model. You use a specialized skill to solve a high-value problem for clients one-on-one. The margins are excellent and the cash flow is fast, but your income is mathematically capped by the number of hours you can work in a day. This flowchart maps the absolute top of the leverage ladder: digital products. A course, template, or piece of software is built once, and then sold an infinite number of times. There is zero marginal cost to duplicate it for the next customer. This perfectly mimics the asymmetric risk model of private equity. Your downside is capped at the time it took to create the product, but your upside scales indefinitely because the software handles the distribution for you. The math is rigid. As long as you are trading a chunk of your finite lifespan for a heavily taxed linear paycheck, you will stay exactly where you are. You have to stop spreading your energy across 10 different trends you don't fully understand. Choose one specific domain, learn its mechanics intimately, and concentrate all your focus there. The execution formula is straightforward. Find a specific problem people are paying to solve, build a reliable solution for it, and package that solution into a scalable digital asset. Building the product is only half the equation. You must ensure you retain complete ownership and control over the equity of that digital system. Without equity, you are just doing high-paid labor for the platform. The traditional economy requires your continuous labor to function. Escaping it means abandoning the accepted rules of hard work and using the laws of asymmetry and leverage to build a machine of your own.